The S&P 500 is everywhere, and we hear the same advice wherever we turn, that all you need to do is own the S&P 500 and you'll be fine.
S&P 500 index.
Let's talk about the famous S&P 500.
It says that there are 3.4 trillion US dollars indexed to the S&P 500.
Most people out there should just own a low-fee S&P 500 index fund.
The S&P 500 is probably the most quoted index in existence.
But even with an amazing track record and the support of the big man himself, I do think that we need to consider whether or not the S&P 500 is truly all we need. There's a few things that don't get mentioned here on YouTube, and there's a few key details that I think are worth covering that might make you think twice. First off though, let's understand what this index is all about, and more importantly, consider why it's been so hard to beat. Now, if someone asks you to explain what the S&P 500 is, you'll often hear something like this. It's an index of the biggest 500 public companies based in the US. And then for a bit more detail, they might add that it's sorted by company size or market cap weight. Right now, here's what the index looks like. From the top to the bottom, you have some of the biggest names in the world like Microsoft, Nvidia, Apple, and as you can see, there's a percentage next to each of them which shows just how big they are in comparison to the index as a whole. Now what this means is that if you were an investor who used an S&P 500 index fund as an investment today, and you put in say £100 or $100, this is the percentage that you'd get of each company with that money. The bigger the company, the more of the stock that your money would buy. Nice and easy, and I know a lot of you watching will already know all of this part. However, here's where some of the more interesting details come in. Firstly, the S&P 500 isn't just the biggest 500 companies in the US. There's no automatic way of getting in just because you reach a certain size. This doesn't get spoken about much, but to get added into the S&P 500, you actually need to meet a certain set of criteria, and then you also have to wait to get selected by a committee. It's very possible to meet all of the criteria, but not get on the S&P 500 for a while because the committee has chosen a different company, for example. The latest criteria to even get considered for selection are the following. You must be domiciled in the US, simple enough. You must be listed on one of the major US exchanges like the New York Stock Exchange or the NASDAQ. Then you also need to have a minimum market cap, which at the moment is $18 billion as per the latest requirements. And finally, you need to have shown profit over the last 4 quarters, and most importantly, in the latest quarter. Now this final part is what makes things interesting for me, and might be one of the reasons that this index has been so successful. Basically, this stops companies who might have become really big in terms of their share price, but haven't yet delivered a real profit. So in a way, this helps stop some of those hype companies that you might sometimes see at the start of a bubble. Now, on a final note, remember that even if you meet all of those requirements, you still then have to be selected by the S&P 500 committee. This is just a group of people who meet on a monthly basis who all work for the company S&P Global. It's completely up to their discretion which companies get selected and which ones get relegated out. And you could argue that this element of selection gives the index its edge. Some people in the past have even argued that this is almost like active management because it's not purely based on the rules and methodology. They do have some say in what happens. However, with that said, this index is one that has been super tough to beat. It lets those winners run, it doesn't try and time the market in any way, and there are dozens of ETFs that track the index that we can buy as investors, which are some of the cheapest out there. In terms of performance, the numbers are just staggering. If I grab some historical data and pretend that you started with $1,000 and never touched your investment, making sure to reinvest any dividends, you would have more than $760,000 in your account today. This works out to be an average return of more than 10% a year. And even if you want to take inflation into account to make things real, you are left with $68,000 all from your $1,000 investment. It's almost too good to be true when you look back that far and consider everything that's happened. All you would have had to do as an investor is stick with it and never look at your account for a second. Of course, that's easier said than done, but still, it's very impressive nonetheless. So what's the catch? What's missing? And why have I made a video suggesting that you might need more than just the S&P 500? Okay, hear me out, but the main point I wanted to show you was this. If you invest in the S&P 500, I'm going to assume that you're doing so because you know some of the basic foundations of investing. You know that any good investor needs to be well diversified, invest for the long run, and invest regularly if they want to succeed. Also, you'll know that an index like the S&P 500 has actually beaten most professional money managers over the long run. In fact, if we take a look at the latest data on this, over the past 15 years, only 12% of all large cap funds have managed to beat the S&P 500, even with all of their resources and teams of analysts. Now, going back to the concept of being a passive investor, if you just invest in the S&P 500, you know that you will get a well-diversified set of investments that operate all over the world. However, when you compare the S&P 500 to the rest of the global stock market, you have to ask yourself the question, is this enough for you? So here's the numbers worth looking at. If you add up all of the companies on the S&P 500 by their market cap, you get to this enormous figure of $46 trillion. It's one of those huge numbers that you almost can't even put into perspective, but let me try and make some sense of it. Now, if you zoom out and look at the whole of the United States market, if you add up all of the companies here, including the S&P 500, you get to $54 trillion. So this means that the S&P 500 makes up 85% of the total US stock market. Now, would owning the other 15% of the companies make much difference? Maybe, maybe not, and I think it probably won't matter too much over an investor's life, and they'll be doing probably better off focusing on just getting more money into the market. However, let's take this one step further and zoom out on a global level. So now that we're all the way out, how much is the entire global stock market worth if we add up all of the companies that we can buy on public markets? The number we get is $80.5 trillion. Another enormous number that's hard to imagine. So now let's make a comparison. If we now take the S&P 500's market cap and compare this to the world, we can now see that the S&P 500 makes up 57% of what we can invest in. So this for me is where I start to wonder, is the S&P 500 really enough? And what happens if we miss out on 43% of the rest of the stock market? There's an entire world out there that you potentially miss out on when you only invest in the S&P 500. You miss out on all of Europe and the UK, all of Canada and Japan, Australia, and don't forget places like Taiwan, South Korea, and all of the emerging economies out there in the world. Now, clearly, nobody knows the future and where the best growth is going to come from when you're an investor. If it was that easy, then we'd all be doing the same thing, and in the end, it wouldn't work anyway. The only way you can get great returns is by doing something that most other people just aren't doing. Let me show you what I mean, though, in some more detail. Now, we can all agree that the US market has been the place to be for a very long time, and certainly during my investing lifetime, it's been the only game in town. However, just like we did before, what if we zoom out a little further and see if this has always been the case? Can we learn something from a bit of history to help us figure out what we might want to also invest in? On screen now is a useful chart showing 5-year rolling returns of the US markets versus the international markets. It goes back until 1975 and it shows when the US markets have beaten the performance of international markets. When US markets have done better than the international ones, the blue lines are above the middle line, and likewise when international does better, the blue lines are on the bottom side. Now, as you can see throughout history, there's generally been cycles where the US and international markets take turns in outperforming each other. For example, you can see here in the late 1980s when international outperformed, as well as during the period through the global financial crisis. Most recently, for more than 13 years, the US markets have dominated and outperformed the international markets. Now, I have no idea if this continues or takes a turn, but I do know that it becomes harder and harder to outperform the longer you do it for, as the law of averages catches up with you. For example, if you grow 20% a year for many years in a row, you end up so big that it becomes harder and harder to continue to do it. At some point, your growth has to slow down, and this leaves open the opportunity for other companies and other countries to start to shine. However, there's no time limit on this one, and I'd be very careful to suggest that you can kind of predict anything moving forward. I just wanted to give it some attention as a reminder that there is a bigger world out there. Consider this, what are investors looking for? They want to make money. They want to make money by investing in companies that are growing fast and making profits. Investors also make the most money when they get in earlier to companies that haven't yet got all of the attention from the financial news media. And surely you would expect more of these to appear in the less popular markets. Anyway, like I said, we have no idea what happens next. The point I really wanted to make was that you could be missing out if you only have 57% of the global stock market. What if we end up going into a decade where the US still performs well, but the international markets kind of perform slightly better? Is that a risk that you want to take, or do you rely on the track record of the S&P 500 to get you through. I'd definitely love to get your take on this one in the comments section, and I'd be really interested to see if your opinion is different based on whether you live in the US or outside of the US, like most of my UK audience does. I'd argue that as investors outside of the US, we also have the risk of currency exchange rates too, and this is something else we might want to consider. I'd also argue that you could easily fall into the trap of just chasing performance, or at least the most recent performance. Investors who are around my age, I'm 35, have not seen a real downturn in the economy in our investing lives. You can count 2020 if you like, but that went down and came back up again so fast that it almost didn't even register. I wonder if we'd started investing at a different time, would our opinions change? Just on that point about past performance, if you really just went after the index funds that performed the best over more recent times, then why wouldn't you just invest in something like the Nasdaq 100, often referred to as the QQQ? This has done almost twice the returns of the S&P 500 over the past 25 years, going all the way back to just before the dot-com bubble. And sure, it's benefited from the dominance of tech companies, but you can easily make the argument that this will just easily continue and technology will play an even more critical role moving forward. For me personally, here is where I just hold my hands up and say, I have no idea what will happen to the stock market in the future, and nobody else does, but plenty of people will claim to on YouTube. And this is why I much prefer to be invested globally. That's not to say that I think there's anything wrong with the S&P 500 or that I somehow think it's going to magically drop over the next few years. I just prefer to sleep with the knowledge that I own almost every stock in the world, including everything in the S&P 500 at their market cap weights. Now, please do let me know what you think about this in the comment section below. As always, it might get a little spicy down there. Anyway, I'll see you in the next video. As always, happy investing.